Welcome back to Next Gen Investing. I'm Renita Young alongside Ben Lichtenstein, and we're looking at under 30. This name for today is Carnival Cruise Line. This stock has gotten quite a bit of revenge travel over the past few months, right? Apparently, the wave season was one of the most successful that it's seen in a while. That's the time where people start to book their vacations for the summer and maybe early fall. But let's find out a little bit more about it. Ben, what are you thinking first?
Well, this is a stock where, in many ways, I guess for the longs, one could argue that their ship has come in because we've done really well in shares of CCL. This week, a big move from 1390 up to 1868, and I notice, kind of ties into what we were talking about earlier about those worst case recession scenarios not coming to fruition, worst case recession scenarios being pushed back. This month we saw a rally from 12 up to, well, now near 19. We were around $8, if you remember, to begin the year, Renita. This year, we've basically more than doubled in price. So from last October down around $6.11, all the way up to 1868. This is a stock that's doing very well, holding above the 50, holding above the 200-day moving average since the beginning of May. If you remember, we double bottom, formed around 850 back in March and April of this year. Back to April of last year levels now, 6 out of 7 of the last weeks, Renita, have been to the upside. So I think this really speaks to some of the strength we're seeing in some of these individual travel stocks as services continue to be in demand.
And this one's so strong, it got a couple of upgrades today. And why don't we bring in Jeff Pierce? He's Senior Manager of Derivatives at TD Ameritrade to talk about more. Jeff, tell us what is happening with this stock right now. What are your thoughts?
Well, as you mentioned, demand has been very strong. We've seen analysts weigh in, especially since their earnings report on the 26th. Today, we have Tigress Financial raising the firm's price target to 23 from 13, keeping a buy rating on the shares. The analyst says the company continues to benefit from strong travel demand and is on track for record revenue and cash flow by mid-year that will drive further share price as well. The firm adds that they expect strong consumer spending on travel, booking pricing, and onboard spending to continue to drive a major recovery in the business, which they expect these business performance trends that they're going to exceed peak 2019 levels. And as you were talking about, I mean, we see this move, price target move from 13 up to 23. They've been trading above $13 since June 9th. So this may seem like a bit of a late price target adjustment, but I think a lot of analysts and investors are kind of watching the stock. Demand has been very strong. They closed out the previous quarter with about $7.2 billion in customer deposits. That's well above the records we saw pre-pandemic of around $6 billion. But the concern is, when does this demand start to level off, and how severe is that? We know it appears like they've got a path to profitability. But this demand is really pent-up demand from the pandemic. The expectation is that at some point it is going to start to slow down. And of course, one of the looming issues for a lot of investors out there and analysts is if the consumer starts to change their spending habits. We've already seen them change them in stores. They're getting away from discretionary items. They're going for lower-priced items. At what point, if at any point, does the investor say they're no longer going to spend money on experience in the way that we've seen lately?
Something else that's been a concern of investors with this stock and other travel stocks has been the debt load that it's taken on. Now, the company is trying to chip away at its debt load, but where do we stand right now?
Yeah, Carnival had about $34 billion in debt to pay off. The company said it had about $1.4 billion off its peak debt after paying down about $1 billion of variable rate debt in last quarter. So we've seen that continue to happen. We're watching them pay off debt. That is a big question mark, though, if we see demand start to drop, what sort of payments we're going to see on those debt burdens. Expenses are also rising as well. We saw expenses rise almost 19% to about $736 million. But at the same time, we're seeing passenger cruise day increase over 91%, occupancy for Q2 over 98%, and expectations for the most part are pretty good next quarter. I mean, Q3, the company expects earnings per share of 70 to 70 cents. They're expecting the occupancy at over 107% or higher. And then for full year, they expect occupancy about 100%. So some pretty strong numbers on the outlook.
You know, Jeff, I'm curious, obviously the overhead there is a concern, but kind of getting back to the concern that you raised earlier as far as, sounded like you were saying maybe a best case scenario has already been priced in here. And we were getting back to what we were talking about earlier as far as Live Nation and tying in some of this demand for services and strength in employment. I'm wondering if we were to see labor conditions here in the U.S. start to falter and give way a little bit. I mean, I always joke around and say it's not a vacation if you don't have a job to come back to. It's called unemployment.
Yeah, exactly. And I think that's what investors are concerned about. Now, there certainly is a longer runway situation where we don't see demand level off. And if we do see it level off, it maybe does it in a more gradual way, right? I mean, certainly the stock still has room to run. We know that all-time high was a little over $72 in 2018. Even if we look back just 3 years ago, they've been up over $31 in June of 2021. So there is still room to run in the stock. If we see inflation come down, if we get more confident about the economy, we may see this demand level off at a much slower pace, which would be very good news for a company like Carnival Cruise. Keep in mind that Q3 is coming up. That's one of the busier seasons for them, so that's certainly going to be important from an earnings perspective.
Jeff, in the 30 seconds we have left, what do you think will be the next impetus for this stock?
I think they're really going to be looking for profitability. I mean, just that step in the right direction is what investors are looking for. Paying down debt, as you mentioned, is going to be a big deal as well, but we're looking at profitability mostly.
All right, Jeff Pierce, thank you so much. Jeff Pierce is Senior Manager of Derivatives at TD Ameritrade of Derivatives Trading.